My name is Pete Keers, and I'll be your moderator today. I'm Senior Engagement Manager for OnApproach. OnApproach is a CUSO focused on data and analytics. Since launching our M360 Enterprise Data Warehouse solution, we've made it our goal to provide credit unions with the means to transform their data into action that benefits members. Our topic today is Fueling a Bright Future for Credit Union Analytics. Our presenter today is Austin Wenzlaff, Vice President of Business Development for OnApproach. OnApproach M360 Enterprise is a universal analytics solution that empowers credit unions to take advantage of all their available data. With M360 Enterprise, credit unions can integrate member data into a single source of truth, enabling collaborative analytics on the CU Analytics platform. Today's webinar will include a high-level overview of OnApproach M360. Austin Wenzlaff joined OnApproach in 2013 as Business Development Analyst and is now currently Vice President of Business Development. He graduated from Gustavus Adolphus College with a BA in Financial Economics. There will be a question and answer at the end of the presentation. Please feel free to ask questions via the chat or the questions function during the session, and I will read those during the Q&A. So with that, Austin, I'll turn the presentation over to you.
All right, thanks, Pete, and thank you everybody for joining us today. Like Pete mentioned, today I want to talk about data analytics and making that a reality for credit unions. I know it's a big, interesting topic, a lot of hot topic for the industry today, so we want to talk about how we've been making that a success for a lot of the credit unions that we work with today. To get started, I know I can't see you guys physically, but just take a moment and think about your guys' budget for analytics. Do you have a budget? Do you not? If you do, what is that amount? How much are you guys actually thinking about budgeting for 2018, 2019 going forward? And the reason I ask that is because one of the big banks last year, one of the big four, this was their budget for analytics. It was $100 million for just analytics. We're not talking about anything else that institution was doing. It was just for analytics. And the reason I wanted to bring that up is because, as Pete mentioned earlier, we're talking about collaborative analytics today, and that's a point I really want to drive home, is that this is something that's very large, very costly, very time intensive. It's not something we expect one credit union to be able to take on their own. It's really about this industry collaborating as one, and that's what the OnApproach M360 solution really enables this industry to do. So we have big competitive threats out there with hundreds of millions of dollars to spend on this, where we as credit unions, individual credit unions, don't have that, but as a collective whole, as an industry, we start to be able to have means to effectively compete if we can work together at this. So some of the key takeaways that I want to give you guys today is for one, we'll talk about reinvention. So the ability to actually look at yourself, look at your credit union, and say, what do we need to do to prepare for the future? And part of that's going to be this overall umbrella that we refer to as digital transformation, being able to just transform your organization to think more about the digital world. And part of that too is really thinking about CU 2.0, Credit Union 2.0. There's a book that came out, Kirk Drake is the author of it, that really talks about that. And that's kind of the presence that we want to go forward on here, is think about the past credit union industry, and now let's think about us in the second version going forward in the digital era. Also, we want to talk about some of the challenges. I want to bring up some what we've seen in the industry. OnApproach has been in the credit union industry since 2009, doing nothing but data and analytics. So we've seen a lot of stuff that's a challenge for credit unions. I want to share some of that today, and then we'll talk about the opportunity. So get into what we see, the successes that we see coming from the industry. And part of that's going to be through collaboration, like I mentioned already. That's a very important piece of this initiative. And then I'll show you guys, or share with you guys, some real examples. So like I mentioned, we've had clients that have been on our solution for almost 10 years now. We've seen some real results, some really exciting stuff that I want to share with you, so you can kind of take that home and start to think about it at your credit union. So just to get started, talking about disruption in the industry, but not necessarily our industry to start off with. So what you're seeing on the screen here is pinball machines versus PlayStation sales. So think about the pinball machine. Back in the 80s, it was a very hot tool, or very hot item that people loved playing. Even some people even had them in their houses. Well, a funny thing happened in the late 80s, or in the early 90s, I should say. PlayStation came out. So pinball machines were at the peak of their sales in the late 80s, early 90s. PlayStation comes out in the early 90s, and it just drops completely off the map. Pinball sales do. And PlayStation goes the opposite direction. It shoots up. They start selling tons and tons of units, millions of units. And that's really the disruption curve that we've seen in the past, where you have this new technology that comes out, and it takes about 10 years. It took about 10 years for pinballs to really be displaced by the PlayStation. So there was a little while for them to kind of figure it out and realize that there's some sort of competitive threat happening. Well, that was the old way of disruption. Today, we're dealing with something that many people refer to as big bang disruption, where on the curve or on the slide here, you'll see the old technology adoption curve, which had the innovators, the early adopters, the early majority, and so forth. That was the traditional adoption curve that we've seen throughout years and years throughout different industries. Today, what's happening now with big bang disruption is that we have basically two phases, and they happen very quickly. You have a trial user beta phase, and then you have mass adoption. Everybody's now using it. And a primary example of that would think about a new operating system on your phone, whether it's Android or the Apple iOS. You have some beta testers, and then one day everybody just downloads it. You have millions of people that adopt that technology. That's what we're living in today. We're not in an industry or in a time where we can start to kind of relax and wait and be reactive to changes. We have to start to think about how do we be proactive rather than reactive, and think about how to change, how to digitally transform ourselves before it's too late. And this is a great example. I love talking about the iPhone, because if you think about it, iPhone is a primary example of disruption and digital transformation of itself. They've basically cannibalized themselves over and over again. And you'll see that the first iPhone came out, only about 10 years ago, 2007. And there's been so many different phones that have come out since then. So many so that a lot of them aren't even on the screen. There's a few generations missing. And the thing about that is that iPhones, or Apple, spent billions of dollars, hundreds of millions, if not billions of dollars, developing each one of these phones, to only 6 months later say, that phone's not good enough anymore, let's build a new one. So they're constantly thinking about, how do we compete? How do we stay relevant? And they take this $1 billion investment and basically say, yeah, that was last year, that's old news, let's build a new $1 billion phone. So that's what we're dealing with today, is constant reinvention. We have to think about how do we be better? How do we be better when and stay ahead of other competitive threats? And Netflix is a great example of that. So Netflix actually got started back in 1999, and they started off, they had about 30 employees, they launched a website, and they started shipping DVDs to your home. That was the new idea, no one was really doing that. In 2000, they got offered for an acquisition by Blockbuster. Blockbuster came to them and said, we'll pay you guys $50 million for your business, which, for any entrepreneur that started a company a year ago, that's a pretty enticing offer, $50 million for a year's worth of work. But they denied that offer. They actually turned Blockbuster down. And 7 years later, by 2007, they had delivered their billionth DVD. So extremely successful, definitely one of the top players in the video rental space by doing the shipping of DVDs. Well, they didn't stop there. They actually, the year later, they came out with streaming. They said this DVD shipping service, that's not the way people are going to continue to consume media. They want to consume it in their home. So we have to develop a means to stream that into their home. So basically, they went from the peak of success, we've now delivered 1 billion DVDs, life is good, to saying that way is old, let's think about the new. And they ended up doing that streaming service, and that's what we know of Netflix of today. And then again, 2016, they actually went through another reinvention cycle where instead of buying content from others and paying for other people's content, they're now producing their own. So they're now in the production business. And today, I actually think that their market cap is over 100 billion now. So you look back at 2000, they were offered 50 million. I'm sure they're very happy with the fact that they turned that down, because now they're worth 100 billion versus 50 million. And obviously, the one that I just talked about there, we know what happened to their Blockbuster. They didn't reinvent themselves. They had a successful business. People came in, they shopped for their DVDs, they took them, they went home, and life was good for Blockbuster. They thought, there is no reason for us to change what we're doing. We're very profitable and it's working just that way. Well, they're now dead. You know, they're completely bankrupt. There is no Blockbusters anymore. And that was because of the failure to reinvent. And I know I can't pull you guys here like I could if you guys were a live audience, but just take a second to think about this company and see if you can guess what company this is based off their stock price growth. So in 2008, their company was worth $2.83. In 2017, worth about $200 a share. And I think most of you guys are probably guessing technology companies, Amazon, you know, Netflix, any of those companies that have seen explosive growth in the last few years. But in reality, in fact, it's actually Domino's Pizza, believe it or not. And the funny thing about Domino's is their growth isn't because their pizza is better. It's not like they, in 2008, decided, let's build a better pizza and people started loving it. Their growth came through digital transformation. They realized that we need to be everywhere that our customers are. You know, if they're online, if they're on their mobile device, even if they're on Facebook, we need to be there and giving them the opportunity to interact with us and order a pizza. So Domino's allows you to have that app. They even allow you to order pizza using emojis on Facebook Messenger. That's how involved they are in the digital world, is that I can go on Facebook Messenger, you know, I could be as lazy as possible and just hit a pizza emoji on my phone, and now I get a pizza to my door. And that's, you know, that's kind of the world we live in. There's a lot of millennials out there that don't want human interaction. I don't want to have to call you and talk to you or, you know, deal with you in person. I just want to be able to get it the way I want it from whatever means I want it to. It's about that convenience factor. So from a challenges perspective, you know, where do we see this industry at? Where do we see the challenges for us acting like one of those companies I mentioned earlier? Well, we really see, you know, kind of the credit union industry at the bottom of this curve right now. So this is an analytics, you know, digital transformation adoption curve, the ability to use your data more effectively and start to give that exceptional experience to your members that we talked about. So at the very bottom of this curve, we have credit unions kind of struggling just to kind of understand and use their data. But at the very top of this curve, you see other companies that I already mentioned today. And the thing about that is that that's where our members' expectations live today. You know, our members are getting this exceptional experience elsewhere, and they're saying, you know, I want that everywhere. So just because we're their credit union or your financial banking institution, that doesn't mean that they're going to give us a special pass. They're going to expect the same service, the same experience, you know, the same high touch relationship that they get with their other providers out there. So that's really why OnApproach came into the marketplace and realized that someone needs to come in here and enable credit unions to get to the top of this curve and to do it very quickly. We don't have multiple years to figure this out. You know, we have weeks, months, you know, more of a time frame than years. But we're very optimistic about this. We're very optimistic about the industry. We think and we know from the success we've had with our current clients is that we can get you to the top of this curve very quickly. We can enable credit unions to start, you know, behaving in a way like some of the big fintech companies do, or some of the other players like Amazon, Domino's Pizza, and start to provide that exceptional experience that our members desire. Another one of the challenges that we see in the industry today is the growth of data. You know, there's this explosive growth of data pretty much throughout everything that we do in life. And I would definitely bet money on the fact that we've created data since we've started here today. You know, for one, we're recording this webinar, so there's data there. I'm guessing at least one of you has sent an email, sent a text message, maybe took a picture of one of my slides since we've started this. So there's data just being constantly created for us to potentially use and leverage. But the data growth in and of itself is a challenge if we can't use it. And the funny thing, or one of the things too that I wanted to call out is on the slide here, you're seeing a picture of a guy from Google. His name's Eric Schmidt, and he's one of the executives at Google at the time in 2010. He actually came, or at 2010, he said in a presentation that from the existence of mankind until today, we've generated as much data as we generate now every 2 days. So from the existence of man to today, we now generate that much data every 2 days, and that speed is increasing exponentially. And that was in 2010. That's a little dot on this chart here. We're now in 2018, and that trend is 100% spot on. He was right, and it is continuing. It's growing even faster as we have new technologies and new ways of creating data. Another challenge, and this is going to be consistent across the entire credit union industry, is disparate data. So when you think about all of your different data systems that are sitting throughout the credit union, they speak different data languages. Each different department has their own way of looking at things, like a member, for example. That's kind of the world that we live in, is that it's very hard for us to make sense of our overall data picture because we just don't have the means to do it. It is very tricky with how it's all set up kind of in these different disparate data silos. And the other thing that's a big challenge with that is that most credit unions are in what I like to call Excel hell, where you don't have tools to effectively mine data. So we're trying to make do with what we do have, which is Excel, and it's not a very good tool for that purpose. It serves its own purpose, but not in the data integration, data analytics realm of things. And then another challenge that we're seeing with the industry today is the outsourcing of analytics. There's this heavy reliance on sending our data out to different third parties to have them analyze and basically monetize our data for us. Well, we're concerned about that. There's two real big concerns that we have with that. Number one is security. Anytime you send your data out of your four walls, your firewall, you're putting yourself up for risk. So we want to avoid that as much as we possibly can and not always be sending our data just to somebody else. The other big reason is the monetization value of data. When you think about your data, you have to be thinking about its value and what it actually brings to the organization as an asset, because that's what it is. It is truly one of your most valuable assets. And when you outsource your analytics and you send your data away, you're actually giving that value to another third party. You're allowing them to monetize your data on your behalf. And a lot of times what we see is that they actually turn around and sell you your data back to you. It might not look that way. It might not come in the form of raw data. It might come in the form of a new predictive model or a new dashboard or whatever it is. But that's really what they're doing, is they're taking your data, they're making it look a different way, applying some algorithms, and then they're selling it back to you. We want credit unions to be able to do that on their own, where the infrastructure lives in-house. You have the means to do that versus having to rely on other people for that. And then this has been obviously a chronic problem for credit unions in a lot of technology areas, not just with data and analytics, but the lack of resources. We're credit unions, we're financial banking institutions at the end of the day. We're not technology companies, nor should we have to be. So a lot of these initiatives, these data and analytics initiatives, require a lot of resources that we don't have today. There'd be new hires of different positions, and a lot of times we're bogged down by other things that we think are high priorities, and we don't have time for initiatives like this because we just don't have enough resources to get there. So, from a technology perspective, in regards to that, what do you all need to kind of get to the top of that curve that I showed earlier? Well, step one is really the enterprise data warehouse, and you can call that whatever you want. You can call it a data warehouse, a data model, a data integration middleware. We call ours a data platform because it's a consistent platform for all credit unions, and that's really what enables that collaboration. I'll talk a little bit about that in a slide here. But basically, whatever you want to call it, it all leads back to the same thing, which is establishing one single source of truth for the credit union. I don't have multiple different spots to get data, and I'm not getting multiple different answers to the same question. I have one spot to go to get all my questions answered. And I know, and all of the credit union agrees and has come to conform on this, that this is the one spot. We all believe this data. It's good, it's true, it's validated, it's clean. So that's really step one. And I like to always use the analogy of that's the foundation of your house. You don't build a house before you pour your foundation, and you make sure that you pour that foundation to be very strong and last the test of time. The same thing goes for analytics. You need to have a very solid data foundation before you can do any sort of reporting, analytics, and so forth. But then once you have that, that's when you can start to get into more of the exciting stuff that everybody likes to talk about, which is business intelligence. Business intelligence is more of like your report writing, your dashboarding, backward-looking questions, things of that nature. How many new checking accounts opened yesterday versus today? And then the next step up on up that curve that I showed earlier is predictive analytics. the ability to actually take your past historical data and extrapolate that into the future. So examples of that would be things like next best product analysis. What does that member need next? How can we be proactive in that experience? Other things would be like probability of attrition. How likely is that member to leave our credit union? How can we better serve them? How can we keep them? So forth. Another one is CUSO, actually. Everybody's focused on CUSO right now, but a lot of people overlook the fact that it's really a predictive model. We're now being required or asked to do ALLL forecasting down to the loan level through predictive analysis. So there's a lot of different use cases for it. And then the last piece of this is really the expertise. And from that, you have business intelligence, you have report writers, you have data architects, you have ETL developers, you have data scientists. There's also some other resources that would be involved, like database analysts, a whole bunch of other resources. It's a very timely, very expensive initiative for any credit union to take on. Again, that's why we say this is an individual credit union challenge or opportunity. It's really an industry challenge and opportunity. And then the last challenge is the speed to market. If you think about the examples that I used earlier about reinvention with big bang disruption, Apple constantly cannibalizing itself, that's the world that we live in, is that we don't have 3 years to figure this out. We have months to figure this out because we have to remain competitive. And traditional data warehousing, traditional business intelligence has, kind of proven ineffective to us because it's taken so much time, taken so long. So that's really one of the bigger challenges as well. And then just to reiterate, this is, like I said already, this is an industry opportunity. This is not an individual credit union opportunity. We need to have a means for all credit unions to work together as one. And that's a common thing that we've done in the past. If you think about ATM networks, you think about shared branching, that wasn't something that one credit union came out and figured out for the entire industry. We came together as a collaborative force, and now we're one of the largest ATM networks in the nation. The credit union industry is. That's pretty amazing, but that was done through that collaboration. So that brings us to what our solution actually is. So just to give you an idea, what our solution is called OnApproach M360 Enterprise, or M360 for short. You'll probably hear me call it M360 more often than not. Basically what we do is we take all of your data that you're going to see on the left-hand side, and we integrate that around a single source of truth. So basically a single member record, branch record, employee record, whatever it is. So for example, on the left-hand side, you might have your core system, your LOS, your credit card, debit card, all of those different systems right now, they live in their own, different disparate data silos. They don't talk to each other. It's very hard to communicate from system to system. What we do is we take all that data and we put it in around that single record, like I mentioned. So for example, assume that it's a member record. John Doe member might show up 10 times in your source systems because he does a lot of business with the credit union. But in M360, you're only going to have one member record for John Doe. But what you will have is every single transaction or every single behavior that member has ever generated with your credit union. So things like, where do they shop? What merchants do they go to? How much do they spend? What's their average spending look like? What's their spending trend look like? Do they have a mortgage with us? Do they have an auto loan with us? If so, what do those payments look like? Have they ever missed a payment? Are they always on time? All of that tells us something. Another great analysis that I recommend every credit union starts with when they start to do data analytics is think about ACH data. Where is the money going to? Where is it coming from? Where do our members have different financial products elsewhere? And how do we bring those into our credit union to further make us their primary institution? So those are all some examples of all of the data that's in M360. So now that you have this single source of truth established, you start to get this 360 holistic view of who your members are, who your branches are, your employees, and also just the enterprise as a whole. So, what I just explained to you guys is basically an enterprise data warehouse, a data model, data integration, middleware, whatever you want to call it. There's a lot of players in the industry that have done stuff like that in the past. But what we realized, OnApproach, what we realized is that a data warehouse isn't good enough for a credit union because, again, it doesn't allow us to collaborate together. It has us on our own, basically trying to do everything from scratch. So what we realized is that if we can develop a common platform for the industry, we can really allow this industry to work together as one. So that's what we set out to do. We set out to build this collaborative ecosystem, this collaborative platform. And really what that means is that we've taken all of these different data sources that you have on the left-hand side, and we've integrated them into one common data standard. You know, the analogy I like to use for that is that we've basically become the Rosetta Stone for the industry, where you have so many different data sources, they all speak a different data language. M360 comes in and translates that into one common language for the entire industry. So why do that? You know, why would we take that extra step? Because it's definitely a far longer, more difficult development process than just building a one-off data model for a credit union. Well, the reason we did that is because it allows credit unions to gain capabilities at an exponential growth versus a linear path that most credit unions have taken in the past. So what I mean by that is that now that we're all working together at one common cause, we don't have to reinvent the wheel over and over again. You know, every credit union wants to analyze their branches. Every credit union wants to do CUSO, ALLL forecasting. So right now we have 6,000 credit unions out there trying to figure out how to do those things on their own. But if you have one common platform, you can now develop that one time, and then you can share that with the 6,000 credit unions out there. So everybody benefits as the platform and the ecosystem starts to expand. So one of the big components of that is our application market. So unlike some of the other application markets that you guys are familiar with, we're an agnostic application market. So it doesn't matter what core system, what ancillary systems you're on, this will work for you if you have the M360 platform. And the whole idea here is that we have one credit union, or it's OnApproach, or it's one of our partners, they develop something, and then that becomes a standard part of our product that the whole industry can now benefit from. So a CUSO model would be an example of that. We have a couple partners that have CUSO models. You know, probability of attrition would be another example. All of those different things come together on this platform, and once it gets developed one time, it becomes accessible to all. The other big component of our solution is the ability to create data lakes or data pools. And that's going to become increasingly more important as credit unions start to venture more and more into predictive analytics and machine learning. Because right now, what we have is small data set sizes. And that's a big problem for the industry, because in order to do predictive analytics, you need to have very large data set sizes. So with a data lake or a data pool, what we can actually do is combine data from multiple different credit unions and also multiple different third-party sources. So whether that's demographic data, you know, social data, all of these different data feeds that come into play, we can now pool that all together for the greater good of the industry, and everybody benefits from that. So that really allows us to do predictive analytics. It allows us to gain greater insights than we'd ever be able to with just our own data. But it also allows us to get cheaper access to analytics. You know, data scientists are expensive, but if you have a data lake or data pool, you don't have to have a data scientist on staff. You now leverage that with the collaborative nature of the industry. So I know I can't open up for questions quite yet, but just to quickly summarize, you know, basically what we've done is we've taken all of your different source systems, and we've found out a means to integrate that data around a common common record, common definition. So you now have one single source of truth at your credit union. But unlike most other data warehouses that do a very similar thing, we realize that there needs to be the next step, the next evolution of that for this industry to work together. And that's why we turned our data solution into a data platform that's repeatable for all credit unions out there. So now every credit union is on one common standard. We can now connect to each other and create an ecosystem of products and services, such as sharing apps through the App Store, such as pooling data for predictive analytics and so forth. And just to give you guys an idea quickly of kind of the difference of the different paths that you can take, there's the collaborative approach that OnApproach is really bringing forward here. And then there's the more of a do-it-yourself or work with one organization on this that isn't collaborative with other industries. So there's this path that's very slow, it's very costly, you know, it takes a lot of time to not get a whole lot of business capabilities. That's more of the custom project, do it yourself, work with a consultant, you know, type of route. The other route is the one that we just talked about, collaborating together, getting all of these credit unions to work towards one common goal on one common platform. And that's where you start to see these business capabilities start to grow almost exponentially. They start to skyrocket up, where the other path is a lot slower and we're not getting nearly as much done. And then just to give you guys an idea of some of the real examples, and we can definitely go into more detail on some of the stuff at a later date, but just for the sake of time here with this webinar, give you a few examples of what our clients have seen or done today that's shown a lot of success, a lot of ROI with analytics. So one of the examples is Ideal Credit Union. Ideal Credit Union developed what they call the VIP Member Rewards Program. And basically, the genesis of that was that they really wanted to be able to reward their members, but they wanted to reward them for their actual profitable behaviors versus just rewarding members because they're members. So they went down that path of developing something with their MCIF system and realized that that's not going to work because the MCIF doesn't look at transactions or behaviors. Instead, it looks at product level month-end snapshot data. So if I have 3 products and another member that has similar demographics to me has those same 3 products, MCIF would say that we're the exact same profitability for the credit union. However, we know that that is not right. It's not about what products a member has, it's about how they use those products. Because one member could use those in a very profitable manner, one could use them in a very unprofitable manner. So that's what Ideal realized early on, and we built them a campaign or a program that looks at about 150 different criteria, credit card swipes, checks written, different types of transactions, activities that yield certain revenue, certain costs, certain expense. And they were able to build this program. And the end result, there was really 2 big outcomes that were pretty exciting to see. Number one was member satisfaction, member engagement went up because these members loved the idea of getting a special dividend at the end of the year. So they wanted to be a part of the inner circle, the VIP members group. So their members got excited about it, and they actually would call them up, or talk to them in the branch and say, how do I become a VIP member? What do I need to do this month to get there? How many more credit card swipes? Which I love because if you think about it, really what they're asking is, how do I make you guys more money? But really, they just want to get that special dividend. They also want to be a part of that inner circle. So that was one big benefit. The other big benefit was more of a nominal benefit, which was that they were able to grow their VIP member group by double digits, about 15% over the course of a couple of years. And the reason that's so significant is because at Ideal Credit Union, like most other credit unions, their top 10% of their members generates anywhere from 80 to 90% of their net income. So for them to be able to grow that group, the VIP group, by that percentage, that was a significant impact to both their top and bottom line. Another great example, and I'll just go through a couple quick here. Another great example is our community credit union. They wanted to be able to analyze their shared branches. It's something they had never done in the past before they had our solution. They wanted to look at it and say, okay, is this providing an experience or an exceptional service for our members, or is it more so a transaction center that's just kind of costing us money, but not giving us a whole lot of benefit? And what they realized is that it was more so the latter. It was costing them a lot of money and not providing that much of a benefit to their current member base. So what they did is they decided to make some branching decisions, minimizing hours, maybe shutting down branches, and they did it in a very proactive manner. So instead of just shutting down a branch and putting a sign up that, hey, your branch is closed today forever, they were proactive about it. And they went to the members that they knew went to those shared branches, and they said, just so you're aware, we are going to be making some branch decisions that will affect you, but we want to make sure that you're prepared without it. We want to educate you. So here's how to use remote deposit capture. Here's how to do an ATM deposit. So the end result of that was that their members were not upset. In fact, they were actually very happy about the situation because they were so surprised that their credit union took the extra effort to teach them how to use these other services. So that was one benefit. The other benefit, again, a more nominal benefit, is that they estimate now they save about $8,000 per month. So almost $100,000 per year just off that one decision that they made. And they're a $300 million credit union, so not terribly small, but one of the smaller ones. So $100,000 goes a long way. And again, that was just one decision they made with our solution. There was a lot of other examples that they've had since they started using our solution a few years ago. And then the last one I'll share quickly from this one here is Affinity Plus Credit Union. They were one of our early on clients. They wanted to do an auto loan recapture program. So basically look at all of the members that they knew had auto loans elsewhere. And again, you can do that very easily with ACH data. So be able to see that this member's paying $300 a month to Wells Fargo every single month. There's a consistent pattern there. It's probably an auto loan. So they went after those members, and the end result of that was that they were actually able to generate almost $10 million in loans in the matter of 6 months. And they did it in a very thoughtful manner. So it's not just every single loan is a good loan, bring it in. It was, does it make sense from the member profile perspective, from the credit union perspective, to bring in each one of those specific loans? So they actually, because of doing it in such a smart manner like that, they were able to yield one of the highest percentages they've done on a recapture campaign in the past, because they were able to look at the institution as a whole from a data perspective. And just to give you guys an idea of some of the, so those are some of the more descriptive analytics, not predictive. A few other things that we're doing from a predictive analytics standpoint are things like member engagement. So, you know, understanding how engaged your member is based off of how they behave or how they transact with you. So that's something that we can look at, and those behaviors always tell us something about that member. So there's this predictive element that you can put into it to determine certain behaviors mean something's going to happen. It always means something's going to happen. So that's one thing that we can do right out the box that you guys could start using from day one from a predictive analytics standpoint. The other one that kind of goes hand in hand with member engagement is member attrition prediction. So, you know, thinking about the probability of a member leaving the institution. And there, again, there's a lot of behaviors that signify that. So we know things like if they have their direct deposit that's flowing in every single day and it's all of a sudden stops, well, maybe they lost their job, or maybe they switched it to a different financial institution, or maybe their transactions on their online and mobile banking channel have decreased significantly, or maybe they don't deposit nearly as many checks, or they don't come into our branch nearly as often as they used to. All of that tells us something about the member. So we can actually score that and tell you how likely that member is to leave. And then we can make decisions based off that. Do we want to go after that member? How do we go after that member and make sure that they stay? Or you can couple that with another type of analysis, like the ideal VIP example. Maybe that member is going to leave your credit union, but maybe they're very unprofitable. They're actually losing your credit union money. Maybe we won't spend the effort to go after them and keep them in here because they're not necessarily the best member to keep. Or conversely, they're one of our most profitable members. We better spend some extra time and effort keeping them happy, keeping them with us and engaged. And then the other one of the more popular ones that a lot of credit unions, like to go about is predictive, or the next best product predictive model. So these cross-selling opportunities, looking at basically past patterns. So different members act in a different way, and when you bucket those members into certain groups, you can start to be able to predict how that group behaves. So a member that's in one group is going to typically behave in this pattern. So they got a checking account, then they got an auto loan. So the next logical step is, you know, a home mortgage. Obviously, just a broad generic example. It could be something completely different, but that's the whole thought behind it, is that you're able to take past historical patterns and extrapolate those into the future to be able to provide that experience to your member, that proactive experience that they desire. And then a couple other ones. This is actually one of our clients. They wanted to be able to actually look at their data from a loan pricing perspective. So instead of just relying on FICO score and what FICO score has to tell us, they were kind of hesitant on that. They realized that the FICO score is more of a backward-looking indicator. It doesn't really predict the future. So if you're coming out of a recession, the FICO score says be very, very conservative because a recession just happened. But we know the opposite is typically true. It's that times were just their worst, they're probably going to get better. And same thing goes for the peak of a bull market. They're saying times are awesome, lend as much as you possibly can, but typically that means that a recession is going to happen soon. So it's kind of telling you the opposite of what you should be doing. So one of our credit unions wanted to build a predictive model on how to price loans without having to necessarily rely on FICO score, because what they realized is that, and what you're seeing on the screen here, is that a lot of the tiers that everybody's fighting for right now, these risk score tiers, are not yielding very much money. You know, you're getting anywhere from 50 basis points to 100 basis points on a loan. It's not a very profitable environment from an interest rate perspective to be in today. So they wanted to go after some of those lower tiers, but they wanted to do it in a manner where they were factoring in risk and going after loans, without having to rely necessarily just on FICO score, but taking in other criteria. So they built a program around that, and they were bringing in external economic factors that affect their region, housing starts, unemployment rates, all of that stuff. And the end result of that was that they were actually able to go after some of those lower tiers and go after it with a very high confidence level that those loans were less risky than what the FICO score was saying. So the exciting thing about that was, well, a couple things. One is that their members were starting to get loans that they never would have gotten because they were being overlooked by FICO score. So any financial institution only looked at them for that. The other benefit of it was that they were able to actually go after some of those lower tiers and essentially double, if not triple, their net interest margin on those loans because everybody was kind of overlooking those areas. They were fighting for the top tiers and not really looking at the bottom tiers. So it was definitely an easy, open opportunity. And one of the things too is that the regulators and auditors kind of came in and said, what are you guys doing? You can't just be lending to anybody you want. And they were actually able to prove to them that their predictive model, by back testing it, was actually more accurate than FICO score had been in the previous period of time. So they basically, kind of signed off on it and said, that's, you guys are factoring in for risk, and they're also setting money aside for risk too. So they are doing, the ALLL forecasting as well, and all that stuff to make sure that they're not exposing themselves to additional risks that they're potentially not prepared for if something were to go wrong. So those are just, those are just a couple examples, and this is actually one of the reasons why they went into that model. The FICO score is kind of broken, is because they looked at these average risk scores, the FICO score, across a whole bunch of different years. And one of the things that happened here was the U.S. mortgage crisis, one of the biggest crises that we've had since the Great Depression. And if you look at FICO score, nothing changed. They didn't really change any of the average risk scores to reflect that we are in one of the worst economic cycles that we've ever had, and it really heavily impacts creditworthiness of members because they're defaulting on loans at a very high rate. But the FICO score doesn't take that into factor because it's backward looking. So it's happened, kind of resets itself. So that was kind of one of the reasons why they said, okay, we need to think about how do we do this differently. And then these are just a couple examples of things that you could do. This is not an example of what our credit unions have done in the past. The other ones were examples of what our credit unions have done. But this one's a pretty cool example. So we know where our members shop. We have that transaction level data from their credit card, debit card, so we can actually see that. Well, this is a Filene research study, which basically shows a heavy correlation between creditworthiness and where members shop. So I know that a member that might have a FICO score of 500, but they have shopping patterns of a member that's usually an 800, maybe we can take a little bit more of a chance on that member using that criteria there, because FICO score has kind of proven them wrong or done them wrong by having them have such a low FICO score, but really they've gotten their stuff together and now they're actually very responsible and things like that. So it's pretty cool analysis where you can correlate different behaviors, different shopping patterns, merchant behaviors to actual creditworthiness. And obviously you're not going to make a loan just off that decision, but it's a factor. It's a criteria that you can bring into it. Another one I don't have a slide on is, I believe it was Filene as well. It might have been a different research institute, but they looked at the correlation between different qualities of motor oil versus creditworthiness. So basically the whole gist of that is if a member buys expensive motor oil, they care about their car and they want to keep that car for a long time. They're responsible and they would hate to have that car repoed. So they're probably more creditworthy than some member that's buying the cheapest motor oil they possibly can. They don't really care about their car. They might not care about paying their loan. So things like that. Obviously, again, it's not the end all be all how you make your lending decisions, but it's a criteria to bring in to enrich the lending decisions that we would make. So in closing, just to wrap it up here, and then we can open up for questions. Like I said, we are talking about disruption. That disruption has started. It's not something that we have years to wait for or years to prepare for. We have to act now. In 2018, I know a lot of credit unions are acting on this, so it's going to be an exciting year. We're really excited for the reinvention of the industry. Again, this is a challenge for the industry. It is not a individual credit union challenge. It's an industry challenge. We believe that collaboration is the only way to go along with that. So credit unions need to come together. And the only way that we see that being possible is through our CU Analytics platform, that M360 solution, because that allows all credit unions to get on one common level playing field from a data perspective and allows us to work together. So that kind of concludes today's webinar. My contact information is up here. Also, we do host a conference every year, co-host it with Best Innovation Group called the Analytics and Financial Innovation Conference. So if you guys are interested in attending that, for being a webinar attendee that was present today, we'll give you guys a special code to save $50. So email me or somebody else at OnApproach, and we'll give you what that special code is, so that you can take advantage of that. And then hopefully we'll see you there in Minneapolis in June. So Pete, I will take it or leave it or turn it back over to you, and we'll go through some of those questions that some of the attendees might have.
Okay, well, I just will ask anyone, if you have a question, please submit it through the question app on the webinar or chat. But there's one of the ones that came up, Austin, was, so if my credit union is interested in doing this, really, how do I get started?
Yeah, I think so. The best way to get started is to get started. I think that's probably not the best answer, but a lot of credit unions, I think, overthink this a lot, that there's so many puzzle pieces that they have to figure out before they start down the path. But a lot of things like data quality and data governance, a lot of that stuff will get figured out through the adoption of the technology. So I think to get started, it's more so of a cultural decision that you guys have to make and getting the credit union together. So this is a strategic priority: digital transformation, data and analytics, and getting all of the different business units together and on board, because that's probably one of the biggest barriers for a lot of credit unions, is that we have these different disparate data sources, but also they're sponsored by different disparate business units. So we have to make sure that we get all of those people to buy in, that data is one of the most important foundations of our organization, and we all agree that the data comes from one spot. So I think getting the organization to come together, agree on that, and then you can start to go forward into buying the solution. But again, a lot of the stuff that credit unions kind of overthink gets figured out as the process goes on. So data cleansing, data quality, all of that stuff will get figured out in a solution like ours once you start implementing.
Great, Austin. Question from the audience is, can you further explain the value associated with working industry-wide credit union data? Why is it better than going it alone?
Yeah, so there's two things there. So one of them is not necessarily the industry data, but the industry platform. If you go at it on your own, you are going to be responsible for doing everything. So you're gonna have to figure out dashboarding, you're gonna have to figure out reporting, you're gonna have to figure out predictive analytics. We're now getting into machine learning. We're also getting into big data technologies like Hadoop, and these distributed databases that allow you to do machine learning and analytics a lot faster. So a lot of the responsibility, a lot of the onus on the individual credit union itself. And this is a very big, fast-changing thing. So we don't expect one credit union to be able to stay up on the times as this changes. Since we've been doing this for almost 10 years now, it's changed dramatically almost every year. And there's something new, some new way of doing it. But then the other thing, more specific to the question, is why use industry data? The reason that that's so important is because, one, is that if you don't have enough data to do predictive analytics, you really can't do predictive analytics. Like, I could run a predictive model, but what's going to end up happening is that my results are going to come back and I'm going to have a very low confidence level. So if I run a model for you and I say, you should price loans this way, but based off the size of data that you gave me, I'm only about 60% sure. Would you want to use results where someone said they were 60% sure? Probably not, definitely not. So with low data set sizes, that's one of the big challenges that we run into. With a large data set size, these big, massive industry pools, that accuracy level goes up significantly. So your confidence level now goes into the high 90s of percents, versus 60, 70, 80. So if someone comes to you and says, now I'm 95% sure that that's the way we should go, you're probably going to sleep a little better at night than if I came to you and said I'm 60% sure. So that's really the biggest benefit. The other benefit that I mentioned quickly earlier is the sheer cost of analytics. Talking about doing data analytics, getting data scientists, with a pool or a data lake, this industry data concept, we can now share that resource very easily across the entire industry because they can run the model one time, and that model will now serve every single credit union at once, because all of those members or loans, whatever we're doing the analysis on, will get scored through that one model. So like probability of attrition, for example, we score every single model, or score every single member on how likely they are to leave the credit union. If you didn't have that industry pool, what you would have to do is you'd have to go, you being a data scientist would have to go individually to every single credit union and say, here's the analysis for your members, and they'd have to go to the next credit union and do the same thing. So you can see where the cost starts to add up. They can run one model one time for everybody, or they can go run it individually, thousands of times. So it's very cost prohibitive to do it that way.